Investors just like you are continuing to navigate this minefield of a market. Continued but slowing inflation, fears of a recession, and the continued volatility. The potential explosives are all around us. So is this a good time to be looking at the municipal bond market? And if so, why? And where are the opportunities right now in that space? Find out right now here on UBS Trending. Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastore. I'm joined today by David Hammer. He is a municipal bond portfolio management lead from PIMCO and a great partner of ours. Dave, great to have you on the show. I wanted to start off with you talking about, first of all, PIMCO's macro view on the markets, because that'll really set the tone for the rest of our discussion. So what does that look like for you all today?
Well, thanks, Anthony. Nice to see you, and thanks for the time today. Our macro outlook calls for a high probability of a recession, the Fed being close to done here as of the middle of this week. And, I'd say when we look at the nature of the recession, our base case is for one that is somewhat shallow and long. Why shallow? Well, households are in pretty good shape coming into this recession. There's a chance that we experience some labor hoarding. It's been harder to hire. Corporate CEOs may be less likely to lay people off into this recession. So unemployment may stay a bit higher than, or employment may stay a bit higher than usual in a recession. And then why long? Well, central banks can't come to the rescue as we've become accustomed to for the last 15 years or so, and that's because of inflation. So a long but shallow recession, I'd say relatively priced in at this point, but our concern is that inflation stays a bit stickier, central bank policy stays tighter for longer, and that exposes risks of a harder economic landing. So that's the way we're looking at our portfolios today, individual credits that we select. I think the good news for the muni market is that munis tend to do well relative to other credit markets in this environment. They have lower default rates, and that's true in any normal cycle. In addition to that, state and local government debt has been improving in fundamental credit quality at the fastest clip in my career over the last few years. Upgrades have outpaced downgrades 3-1. Even some more stress credits like Illinois, New Jersey, have received multiple upgrades for the first time in 25 years. So munis look in a good position to weather the storm, even if it's worse than we expect. And it's at high starting yields, about 3.5% in the IG sector, 5.5% in the high yield muni sector. The potential returns really stand out after taxes relative to riskier parts of markets like high yield corporate credit or even equities in the case of high yield munis.
Yeah, thanks, Dave. That's a good setup. Because interesting, when you look at muni bond performance, they produce pretty positive performance in the first quarter of the year, as you were saying. So let's talk about the liquidity dynamic then within the market. How has that changed since the financial crisis, and how should investors maybe even think about this dynamic given last year's historic flight to capital?
Yeah, well, for starters, investors should definitely be thinking about it because conditions have changed. Over the last decade plus since the financial crisis, broker-dealer balance sheets, the amount of munis that they hold to buy and sell muni bonds every day, it's gone from 50 or 60 billion down to about 10 to 15 billion on average. And over the same time period, daily liquid AUM, so think open-end funds, ETFs, have grown in size to about $1 trillion from 400 billion a decade ago. So if we think about that as a fraction, the amount of capital available to buy and sell munis every day as a percentage of daily liquid AUM, it used to be 10 or 15% of the market. It's down to 1 or 2%. So these big overshoots when we experience both inflows and outflows. Important to note, at the beginning of last year, high quality munis were just about the richest they've ever been since versus corporate bonds or U.S. Treasuries. By the end of the year, they were just about the cheapest they've ever been. So investors should expect this dynamic to continue. It's due to regulation, cost of capital, and really think about how they allocate to the muni space. For our vehicles and our Open-end funds, we tend to run a lot more cash when munis are rich, sometimes 10 or 15%. That ensures we don't have to sell into an outflow cycle. And then we've launched new strategies to take fuller advantage of this opportunity set. We can go on offense during periods of outflows. So for investors that plan to be allocated to the muni market for a longer time horizon, multiple years, they may want to consider a strategy that's not daily liquid to really take advantage of these illiquid conditions that are occurring, somewhat frequently today.
And interestingly, Dave, when you look at different muni charts, you look at something like a AAA muni yield, and there's the 30 years, the 5 years, the 10 years, they're all near highs on that yield side. So maybe you could speak to how that sets up munis in the future, because we're looking at yields that we haven't really seen for a very long time.
Yeah, so with the Fed on the precipice of a pause in yields near the I'd say the top decile of the last decade plus, we definitely agree that yields broadly in the muni market are attractive, and especially if you tax adjust those yields, a 3.5% 6-year duration IG index, that's about 5.5% taxable equivalent yield. 5.5% tax-free 7-year duration high yield muni index, that's north of 9% tax adjusted yield. So historically attractive versus other things you can invest in fixed income markets. The one thing we caution on is not all parts of the muni curve today are as cheap as they have been. Bonds that mature between 1 and about 10 years are actually quite rich right now, mid-2s yield. And we see that as rich versus mortgages, corporate bonds, and treasuries. For our portfolios, we are barbelling very, very short weekly floating rate munis yielding about 3%. And then longer duration munis in and around 20 years and some lower quality credit. That part of the market yielding mid-3s to mid-5s, it hasn't fully recovered from the outflow cycle of 2022. So we see both higher yields, a steeper curve, very different story than corporate bonds or treasury bonds. There's about 100 basis points of upward slope between 10 and 30 years, and also better relative value. So as flows continue to stabilize, we think these bonds offer better potential total return if they mean revert back to levels prior to 2022.
Yeah, and we just flashed the 10-year chart there, but it didn't actually show the yield curve that we've been, sort of the inverted yield curve, I should say, for treasuries that we've been in for a while. But meanwhile, muni yield curves have maintained a pretty upward slope with a little bit of flattening in the last couple months, as you mentioned. So it seems like there's opportunities here. So that sort of brings me to my next and last question for you is, where are you seeing the best opportunities to allocate? I mean, right now you've got nearly all states in a fairly strong fiscal position. What sectors, what geographies, what kind of credit quality are you recommending to investors right now?
Yeah, so starting with the long end of the curve, which we mentioned, why is the curve so steep today? A big part of it is that banks have less of an appetite for muni bonds than they used to. Lower tax rates, mismatch at some banks between deposits and long duration munis. Most banks invest in long duration munis. And we're even now seeing some selling, from FDIC seized banks that are reducing muni positions. So we see opportunities to take advantage of this risk reduction from banks. In terms of credit, we really like local GOs that are backed by pools of U.S. housing. Most local bonds in the U.S. Used to finance local government or school construction. They're ultimately repaid by property taxes, and property taxes are a function of housing values. House price appreciation in many parts of the market up 10, 15, 20%, but assessed values where local municipalities collect their taxes, they have a lag effect. They're just starting to rise today. That's a tailwind for local credit. We like prepaid gas bonds. These are bonds backed by U.S. financial institutions that are issued in tax-exempt form. All the big systemically important banks trading in and around 4.5% tax-free with 5 to 7 year maturities. In the high yield portion of the market, we really like post-bankruptcy Puerto Rico risk. In our view, much higher credit quality than what the market gives it credit for today. Trading between 5.5% and 6%. That would imply a single B credit rating. We think it's credit characteristics in some cases, such as Puerto Rico COFINA sales tax, much closer to investment grade credit. And then last but not least, we're seeing opportunities in some of the less liquid parts of the markets that regional banks used to lend to in particular, multifamily housing, affordable housing, workforce housing. These are very, very high credit quality asset classes, very low historical default rates and pretty good LTVs, but they are not rated smaller deals. And there's an opportunity for investors like PIMCO really to step into the role that banks have been filling here and lend directly to some of these projects at elevated yields.
Dave, thanks so much. Yeah, it's great to hear that you see a lot of opportunity out there. Clearly, we want our viewers to go talk to their financial advisor. And look, we're coming off the heels of the meeting from the Fed. They raised 25 basis points on the 3rd of May, and they took out the language saying some additional policy firming may be necessary, which suggests maybe a pause coming up. So, it's going to be an interesting next couple of weeks to see where the markets go, particularly on the yield and treasury side. And obviously, we'll be tracking what goes on in the muni space. So thanks for taking us through, Dave. A lot going on these days, but good to have you here and taking a little bit of a digestion of what's going on in munis. Good to see you, Dave.
Thanks, Anthony. Take care.
Anytime. We'll see you soon. Again, Dave Hammer from PIMCO, great friend of ours here in the studio. And for more information on anything we talked about today, plus the content that's coming out of our Chief Investment Office here at UBS, visit our Insights page at ubs.com/views. Plus, check us out on social media. We've got a newly relaunched Instagram channel called UBS Trending. You can follow us there. And we've got great content there for you that happens here in the studio, as well as some never-before-seen content that you can only find on that Instagram channel, again, at UBS Trending. And remember, please speak with a financial advisor, especially when it comes to a fairly complicated topic like municipal bonds. Make sure you're talking to your FA to make sure it fits your risk profile. Until next time, I'm Anthony Pastore. We hope you have a great rest of your day. And remember to keep your eyes on what's trending. See you soon, everybody.